Hey, it's Shane with BrickDriven Realty, and today I'm going to answer the question, how much home can I truly afford? This is one of the top questions that first-time home buyers often ask. So today I'm going to take a deep dive and discuss interest rates, purchase price, and debt-to-income ratios. Your debt-to-income ratio takes into consideration the debt that you currently have today, along with the proposed monthly payment of the home that you would like to purchase, or an estimate of what that purchase payment will look like. By combining those, we're able to see what the maximum buying power will be in your affordability based upon your current income in comparison to that debt-to-income ratio. So one of the things that go into determining that affordability factor, that debt-to-income ratio in the future, or after this presumable purchase is made, or the expectation of this purchase is made, the interest rate determines what those monthly payments look like. Today the rates are historically low. We do expect, and we are seeing some trends of those rates increasing. So naturally, whatever that rate is, that rate will contribute toward what we discussed earlier, the debt-to-income ratio. So for example, if the rates, just throwing this number out there, if the rate's 3% on a $300,000 home, and the rate goes to 3.25, then that payment would naturally go up because of that interest. That payment and that new interest amount could cause that debt-to-income ratio to be out of balance. So let's look at purchase price. Let's say you're looking at a home originally in that $200,000 price range. Say we look at a few amenities and everything in a home just down the street in that $250 price range is really, that's really what you're in love with, right? You can see yourself raising children and rocking grandchildren in this home, having Christmases and Thanksgiving, birthdays, other celebrations. The difference between the $200,000 home and the $250,000 home is going to end up being probably in the ballpark $50, $60, maybe even $75 a month. So when we look at it from that standpoint, don't always get so wrapped up with the purchase price, because then at the end of the day, the interest rate that you get is going to be more critical towards that payment than that purchase price. And the difference between the $250,000 home actually comes down to a couple bucks a day. So you don't want to lose that dream home over a few dollars extra on your mortgage each month. So the amount of home you can afford is flexible. So don't get super wrapped up in the purchase price. What you would be best served to do is contact your expert lending partner, the one that you trust to handle your mortgage, and discuss those different rates, different scenarios, say with the $200,000 or the $250,000 or the $300,000 and the $350,000, or whatever that price range may be. But work with that lending expert early in the process. That way you don't have sticker shock, you don't get disappointed with too much of a payment you're uncomfortable with, and also the fact that you might see that your buying power will provide you a much higher price home at a payment that is more realistic to what you expect. That's why it's great to reach out to that lending expert, that trusted advisor in lending, early on in the process. This also prepares you to make that offer and the seller to take that offer very serious. If you wait till after you find what you're looking for and then begin that approval process and estimation of buying power with that lender, in today's volatile market, many sellers won't take you serious, and a lot of sellers won't even consider that offer if you're not pre-approved in advance. In the meantime, if you have any real estate questions, looking to buy or sell, or have any real estate questions in general, please don't hesitate to reach out at the information provided. This is Shane Kilby with BrickDriven, and we appreciate you for taking the time to watch our video today. Thanks so much.